Welcome back. You're watching us here on Halftime Report. Let's get chatting with the management of Chalet Hotels. Reported a steady third quarter set where the revenues grew by 29% and EBITDA zoomed by 46% on a year-on-year basis. The net profit, however, was impacted by higher depreciation, lower other income, and as a result of which reportedly was a decline year-on-year. But operationally and from a top-line standpoint, it was extremely strong, as the case has been for a lot of the hospitality companies. Sanjay Sethi, the MD and CEO, joins in. Thanks a lot, Sanjay, for joining in. Good internals, good performance as well. 71% occupancy, ARR increasing by about 8% year on year as well. Just wanted your thoughts on how these trends pan in the near future over the next couple of quarters. Occupancies obviously will continue to improve, but will at some point ARR hit a bit of a growth ceiling, and as a result of which your average revenue per occupied bed would be led more by occupancy than the rate itself?
Good afternoon. A pleasure being back on CNBC. We're very pleased with the results that we've had this quarter three. And going forward, to answer your question, I think there'll be a mix of occupancy and rate growth. And we see that growing pretty sharply on the rate side, given that the occupancies across India are peaking out. Now, whilst we're doing 71% occupancy in last quarter, which is a 6 percentage point jump on last year, same period, rates on the existing hotel rooms, because we've had some new inventory additions this year, have actually grown by 11%, which is a pretty reasonable jump on the existing room inventory that we had prior to adding the new hotels. And those new hotels will stabilize over a period of time. Overall, I think the hospitality segment that's grown by roughly 29% on revenue, and EBITDA has grown by roughly around, 5 percentage point increase in EBITDA margin to 46.3% EBITDA margin now. We're extremely happy with that. And to just address that question about net margins, last year for the same period, we had an impact of 87 crores coming out of 60 crores in the overall cost side, and we had incremental revenue of 26 crores. So if we exclude that, even on an overall basis, our EBITDA is actually increased by 44%. And the PBT on an adjusted basis is actually 3x of last year, or same quarter last year.
Exactly. Mr. Sethi, what really stood out was those margins of over 40-odd%, 44% to be precise, which were absolutely spectacular for the company. So congratulations on that. But is it sustainable? Are you probably going to clock these kind of margins going forward as well on a regular basis?
Well, absolutely. I mean, of course, there'll be variations that happen on quarter basis because there's a half H1 and H2 cycle that plays out in hospitality. H2 is typically better than H1. So we'll see those variations happen. But on an overall basis, we see no reason why we'll not be able to deliver margins as good as this, if not better.
So what would that, when you talk about variance, what would the range be?
On a revenue basis, typically 55% of the revenue comes in H2, whereas 45% comes in H1. But of course, then this is subject to new additions happening in the portfolio also. Margin-wise, whilst we stayed comfortably over 40% in H1, H2 typically is going to be 45 and above.
Let's look at FY25 then. If you could tell us, you have 130 rooms coming in the Marriott Bengaluru. You have around 70 rooms, which is at the Duke's Retreat in Lonavala, coming in new hotels, which is in the Taj New Delhi. And then you have Hyatt Regency as well. With all of this inventory coming in from your end, what kind of growth are you anticipating in FY25 when it comes to revenues as well as margins?
So 25, we'll not see addition of the Taj in Delhi nor the Hyatt Regency in Airoli. That'll come later. But we'll get the additional rooms in Duke's and we'll get the additional rooms at the fag end of the year at Bangalore also. Also, we got to keep in mind that we've added 88 rooms in October this year. So they'll play out for the first half of next year as additional inventory too. All in all, we see same store growth in comfortably in the double-digit numbers. and these additional hotels will bring incremental revenues and EBITDAs. Look, some of them are going to start off, so they'll start off with slightly slower EBITDA in the first 1 or 2 quarters, and then add or be value accretive to the EBITDA margins going forward. But overall, we expect FY25 to be very good. As a practice, we don't give guidance on forward-looking numbers.
Okay. What about your balance sheet? Can you give us your latest debt figures for this quarter and plans for reduction?
I think end of the quarter, our debt is around the 2,400 crores, which is down from where we were on 31st March of 2023. And this in spite of spending around 300 crores on capex of our growth projects. So we are able to not only cover the cost of capex going on in the company, and we have a high growth company on the capex side due to new projects. We are also able to pare down debt as we go along. So overall, I think the debt seems to be very much under control, and going forward will continue to drop through internal accruals.
And what are you penciling in terms of annuity revenue the next year, in terms of the rent that you get from the commercial portfolio?
So I think we should look at the run rate. I think our run rate revenue will be about the 250 odd crore mark. Some of them will open now, some of them in the next quarter, and the leasing activity will obviously follow suit. But the run rate is around 250 odd crores revenue side, which should convert to in excess of 300 plus crores once we have the final building in Powai also open in about a couple of years from now. But annuity business is clearly something that we have used as a diversification or hedging our risk tactic. Has paid off extremely well because it gives us sort of consistent revenue and EBITDA as we go through the cycles of hospitality.
Okay, all right, Mr. Sethi. We're going to let you go on that note. Thanks very much for joining in and speaking with us. So that's the word coming in from Chalet. And DB